Hello everyone. In our last lecture, we talked about capital market, the meaning of capital market, what are the different characteristics of the different financial instruments that are available in the capital market, the role and significance of capital market, and we also talked about the different instruments that are available in the capital market. Now, in this lecture, we are going to cover up about the different characteristics of the different capital market instruments. So, our first instrument that we talked about is the shares. Now, what is a share basically? A share can be defined as a fraction part of the capital of the company which forms the basis of ownership and interest of a subscriber in the company. So precisely we can see a share is a small part of the total capital. When the owned capital it is divided into a number of equal parts, then each part is called as a share. A person who contributes for a share is called as a shareholder. Now, what are the different types of shares? Shares can be broadly divided into equity shares and preference shares. Equity shares. Let us have a look at what are the different characteristics of equity shares. Equity shares, the shares which enjoy dividend and right to participate in the management of joint stock company, they are called equity shares, or they are also termed as ordinary shares. They are the owners and they are the real risk bearers of the company. Shares which are not preference shares are equity shares or ordinary shares. Equity shareholders are the real owners of the company, therefore, they are eligible to share the profits of the company. The share given to equity shareholders in profits is called dividend. At the time of winding of company, the capital is paid back last to them after all the claims have been paid in full, and so they are termed as owners of residue. Now we will see what are the different advantages of equity shares. The company has no immediate liability to pay back the fund um, that is we can say gathered through the issuing of shares, that is raised by issuing shares. No fixed dividend obligation is also there. The percentage of dividend that is paid, it varies from time to time by the board of directors by framing different dividend policies through board meetings, etc. So, increases credit worthiness of business. Issuing of equity shares also, it increases the credit worthiness of businesses, because usually these companies who are issues shares to the owners, they usually take proper kind of decisions. Their risk are usually low, because as soon as the financial risk of those companies increases, the market price of those shares can crash. So issuing of equity shares, they usually increases the credit worthiness of business. Shareholders, they control the company. Limited liability of the investors are there. High dividends is also expected through high growth and development of the company. Whenever it will take, no collateral security is needed for issuing the shares. So increases firm credibility as well. Now let us have a look at another type of share, that is the preference shares. Why the term preference has come? Preference is actually at the time of paying the dividend, preference is given to these shareholders. That's why these shares are termed as preference shares. Shares which enjoy preference as regards the dividend payment and capital repayment, they are termed as preference shares. They get dividend before equity holders. They get back their capital before equity holders. In the event of winding up of the company, the owners of these shares, they have a preference for dividend, and the first claim for return of capital as well. So when the company is closed down, they have a preference to get the dividend, as well as their first claim will be there for returning of the capital in case of winding up of companies. But their dividend rate is also fixed. Now, what are the different merits of preference shares? They are having fixed dividend, first claim of the company's assets, cost of capital is low because usually their dividend is fixed, so it will not increase or decrease depending on the growth and development of the company. So their cost of capital remain fixed, or it may be low in case when the company is growing at a very high rate. The equity shareholders will increase their expectation of very high rate of dividend from the company. But that is not the case for preference shareholders. No dividend obligations are there. So no dividend obligations in the case that for debt one, there is an legal obligation for paying the interest. But in case of shares, there is no legal obligations. If the company is not making any profit, then it may not pay any kind of dividend. But that dividend is also cumulative, so it should also be kept in mind while issuing of preference shares. And the dividend paid is cumulative. Cumulative means is if the company is going into loss, it may not pay any dividends, but whenever it will start generating profit, all those previous dividends should be made up by the should be issued by the company to the preference shareholders as well. Now, demerits of preferentials. Demerits of preferentials. What are the demerits of preferentials? What are the different demerits of preferentials? Are basically one is not a very high dividend rate. It is usually fixed, no voting rights. They are not having any voting rights. Dividends paid are not tax deductible. So, in any case, the dividend which are paid either to the preferentials, or we can say it is paid to the equity shares, they are not tax deductibles, whereas the interest rate that is paid for borrowed fund, they are tax deductibles. Non-payment of dividend, they affects firms. So these are the few different merits and demerits that should be kept in mind by the shareholders as well as the companies while issuing the shares. The next important capital market instrument is debentures. Now, what are debentures? Debentures are basically when borrowed capital is divided into equal parts, then each part is called a debenture. Debenture represents debt. For such debt, company pays interest at regular intervals. It represents borrowed capital, and a debenture holder is the creditor of the company. Debenture holder, they provides loan to the company, and he has nothing to do with the management of the company. They don't have any kind of voting right and nothing. Only they are the loan givers. Now let us have a different look at the demerits of debentures and merits. Demerits is interest obligatory. Their interest, there is a legal obligation of the company to pay the interest to the debenture holders. So it is high liabilities associated with it, charged against assets, not meant for big firms. So firms which are very much having strong financial credentials or credit worthiness, they should go for debentures. Merits of debentures. Issuing is very cheap. Issuing is very cheap. There is no much rules and regulations which need to be followed, and no dilution of control is also there. Debenture has nothing to do with the ownership. It is just borrowing funds from others. Best for depression periods. So whenever there are some kind of depression periods are going on, debentures can be issued to overcome that depression period. Now we're going to talk about the important instrument is bonds. Now what is this bonds? Bonds and debentures are basically having the same characteristics, we can say, but debentures are issued by corporate sectors, whereas bonds are issued by government companies. So bonds are usually they are issued by government companies, whereas debentures are issued by corporates. A bond is a fixed income investment in which an investor then loans money to an entity, typically governmental, which borrows the funds for a defined period of time at a fixed interest rate. Bonds are issued used by companies, municipalities, states, and central governments to raise money, and they finance a variety of projects and activities. Owners of bonds, they are debt holders or creditors of the issuer. Now let us have a look at the different characteristics of bonds. Most bonds they share some of the common basic characteristics. What are those? First is face value. We should know about what is a face value. It is the money amount that the bond will be worth at its maturity. So basically, we can say that face value is its true value of a bond, or we can calculate this face value by finding the present value of its future benefits. From this way, we can calculate what is the actual value of a fund, value of a bond, and is also the reference amount the bond issuer uses when calculating the interest payments. So basically, whenever they talk about the interest rate of a bond like 10%, it is 10% of the face value. 10% of whatever is the face value of the bond. So that will be the amount of interest that is paid to the bondholders. For example, say an investor purchases a bond at a premium of rupees 1090. Another purchases the same bond at a discount rupees 980. When the bond matures, both investors will receive the rupees 1000 face value of the bond. Right? So here another thing we should keep some throw some light here that what are the issuing price. It can be at par means when the bond is issued at the face value. When it is the issue price is less than the face value, we say that the bond is issued at a discount. When the issue price is more than the face value, we say that it is issued at a premium. So these are the three categories at which a bond can be issued. It can be issued at par, it can be issued at discount, and it can be issued at premium. Now the second characteristics is coupon rate. What is a coupon rate? The coupon rate is actually the rate of interest the bond issuer will pay on the face value of the bond. That is 10%. If we are saying is the interest rate, it is the technical term for the interest rate that is paid for a bond by the bond issuer to the bond holder. That is termed as a coupon rate. For example, if you are saying that the 5% coupon rate is there, this means that 5% of the face value of the bond will be paid every year. That is, if the face value is rupees 1000, so 5% of rupees 1000 is equal to rupees 50 will be paid as interest every year. Coupon dates. What are those? Coupon dates are the dates on which the bond issuer will make interest payments. Typical intervals are like annual or semi annual coupon payments are there. Annual is when the interest rate is paid once in a year, or semi-annual coupon payments can also be there where semi-annually it is paid. Maturity date is the date on which the bond will mature and the bond issuer will pay the bond holder the face value of the bond. Issue price is the price at which the bond issuer originally they sells the bonds. So this is actually the selling price of the bond. Another important one is warrants. Now, what is this warrants are all about? Warrants are basically instruments that give the right but not the obligation to buy or sell a security. Most commonly an equity at a certain price before expiration. The price at which the underlying security can be bought or sold, this is referred to as the exercise price or the strike price. Now, warrants are again, the working of this is similar to the option. One important difference between option and warrant is that it is issued directly by the company, whereas the option is issued by an exchange. Now, an American warrant, there are two types of warrants again. This is also prevalent in options. So, what are those? They are American warrant and European warrant. An American warrant, it can be exercised at any time on or before the expiration date, whereas European warrants can only be exercised on the expiration date. Warrants that give the right to buy a security, it is termed as call warrants, and those that give the right to sell a security, they are known as put warrants. A stock warrant is just like a stock option, we can say. Just we talked about, like, it is the working of the warrant is similar to an option because it gives you, means the buyer of the warrant, the right to purchase a company stock at a specific price and at a specific date. However, a stock warrant, it differs from the option in two key ways. A stock warrant is issued by the company itself, whereas we can say new shares are issued by the company for the transaction. So it is issued by the company, whereas the options is issued by the exchange. Unlike a stock option, a stock warrant is issued directly by the company. When a stock option is exercised, the shares usually are received or given by one investor to another. So we say that another investor is issuing a stock option and either they are selling that stock option from one investor to another. If they are implementing that option, then it is the obligation of one investor to fulfill the right of another investor. Whereas in case of warrant, as we have seen that it is issued by the company itself. So in case an investor is implementing his warrant, then it is the obligation of the company to fulfill its obligation and to complete the right of the warrant holders. When a stock warrant is exercised, the shares that fulfill the obligation are not received from another investor, but it is received directly from the company because the warrants are issued directly by the companies. The warrants tend to have much longer periods between issue and expiration than options, usually of years rather than months. Warrants do not pay dividends or come with voting rights. Investors are attracted to warrants as a means of leveraging their positions in a security. They can also hedge their downside risk. For example, they can combine a put warrant with a long position in the underlying stock or exploiting the arbitrage opportunity. So, this way, the warrants can be combined by the investors to hedge their position and to book profit. Now, another important instrument is derivatives. Now, what are derivatives? A derivative is basically a financial risk mitigating instrument that is used whose value is derived from an underlying asset. So, in that case, this derivative can be used over any of the financial instruments, we can say, like currency. It can be stocks, shares, etc. Types of derivatives are options, forwards, futures, and fourth one is swaps. It's very important. Options are usually it is a type of derivative. Its operation and working is more or less same as the warrant. Because we can say that options, they are contracts that grant the right but not the obligation to buy or sell an underlying asset to the option buyer, whereas the option seller, they have an obligation to fulfill that right of the option buyer. So call option and put option, two types of options are there. Call option is an option which gives the option buyer the right to purchase, whereas put option gives the buyer of the option the right to sell. Convertible securities. A convertible security is a security that can be converted into another security. Convertible securities may be convertible bonds or preferred stocks that pay regular interest and can be converted into shares of common stock. A convertible securities pays a periodic fixed amount as a coupon payment in the case of convertible bonds, or a preferred dividend in the case of convertible preferred shares. And it specifies the price at which it can be converted into common stock. Debt securitization. It is basically, we can say, a process of converting the mortgage loans together with future receivables into negotiable securities or assignable debt. This is basically what is done by, suppose, a bank. They are having a loan portfolio. All the loan accounts are collected together and is formed in a loan portfolio where all those loan accounts are pulled together, and then they are cut into small pieces having a smaller amount of risk associated with it, and then they are traded to the investors. So since the debt of the bank is converted into a form of tradable securities, so this whole process is termed as debt securitization. This is a very important way in which they can mitigate the risk, that is credit risk, that is associated with the banks. Another instrument we'll be talking about is euro issue. Euro issue is basically, we can say, is a name which is given to sources of finance or capital that is available to raise money outside the home country in a foreign currency. These are done through euro issues. The most commonly used sources of funds that fall under the euro issues, you can say, are ADR, like American Depository Receipts, global depository receipts outside America, other than America, other countries, they usually issue global depository receipts, and foreign currency convertible bonds as well. So, euro issues, what happens is, suppose an Indian company, they want to open a subsidiary in another, in America. Now they want some fund in dollar to open their subsidiary there for operations and other purposes. Now, if they will borrow the money in Indian currency, they are subject to currency risk. So it is better for them to borrow the fund in dollar itself. Now, the people or citizen of America, they cannot trust the Indian company, so they cannot easily, the Indian company cannot easily raise fund from the American citizens in dollar. It is difficult for them, so they take the help of another bank, and what they do is they issue American depository receipt through that bank, so that easily fund can be raised from the American citizens in dollar. And after that, the interest rate is paid back to the banks, which are paid to the investors by the bank to the citizens of that country. So this is the working of euro issues. So this is the advantages of euro issues, you can say. Raising funds by way of euro issue, they act as a cheap source of foreign currency funds for the company without exchange risks, especially for the companies that have foreign currency receivables. Euro issues, they also provide a larger market and international access to funds, and may lead to easy, larger volume funding, which may be difficult from domestic sources. It opens up many new opportunities for the fund companies in new markets. Companies gain international exposure and can enhance liquidity for its shares. Certain limitations are also there, like although it is available at a lower cost, but companies which do not have adequate receivables may run currency exchange risk. They may have to incur hedging cost also, which may turn out to be higher than the cost saved. Not all companies can avail funds via euro issues. Companies have to follow the guidelines also issued by RBI, and they meet the criteria to avail the funding through this route. So companies may have to undergo stake dilution if raised by way of equity or convertible bonds. These are some of the limitations that are faced. Now, another important capital market instrument we can say is the fixed deposits. A fixed deposit, it is like financial instrument which is provided by banks or can be provided by NBFCs as well, which provides investors a higher rate of interest than a regular savings account until the given maturity date. It may or may not require the creation of a separate account. The same savings account can be linked with the fixed deposit accounts as well. It is known as term deposit also. They are considered to be very safe instruments. No risk are usually there. But if we are talking about fixed deposits that are offered by the corporates, they are a little bit risky than the banks, public sector banks, nationalized banks, or the private banks. Now, term deposits in India, Nepal, Pakistan, they are used to denote a larger class of investment with varying levels of liquidity. Usually, people from these Asian countries, they uh, deposit a large amount of fund in these fixed deposits. The defining criteria for a fixed deposit is that the money cannot be withdrawn from the fixed deposit as compared to a recurring deposit or a demand deposit before maturity. Some banks may offer additional services to fixed deposit holders, such as loans against fixed deposit certificates at competitive interest rates. It's important to note also that the banks may offer lesser interest rate under uncertain economic conditions. The interest rate usually varies from 4 and 7.25%. Tenure is also there from 7 days to 10 days, 10 years. So that's all for the different instruments of capital market. In our next lecture, we are going to have a look at the different financial intermediaries like brokers, underwriters, depositories, merchant bankers. What are the different roles that are played by them? So till then, thank you everyone.